Let's turn now to how the breakthrough on financial overhaul will shape the talks at the G20 meeting this weekend. For that, we're joined in Washington by Steve Hanke. He's an economics professor at Johns Hopkins University and also a senior fellow at the Cato Institute. Professor, thanks so much for joining us. And what timing, how does this agreement in Congress, how does it change the game for President Obama at G20?
I don't think it changes the game. The U.S. position, kind of as I might characterize it, as kind of an imperialist position in terms of international economic policy, has been one that's pushed for monetary nationalism. That means every country has its own currency and floating exchange rates. More regulation in the financial sector and more stimulus in the fiscal side. So nothing really has changed.
Why do you call it imperialism?
Well, this is smacks of Soviet-style planning, actually, with the U.S. ordering everybody around and telling them how to run their economies and what kind of exchange rate arrangements they should have and what their budget should look like and what kind of regulations they should have in their economies. I mean, this is imperialism of the highest order.
But he goes to the G20, though, being able to say, look, I've set the example.
Well, the example is, of course, a terrible example because the regulation, the bank regulation, is so complicated, no one understands what it is, either in the banks and the financial services sector, or the regulators in Washington, or the Congress. It will end up like the post-Enron legislation that we had, and as you saw with the Supreme Court yesterday, the Supreme Court essentially said the Congress can't write good regulation. Too complicated. No one knows really what it means. And the thing for the economy that's so important about this, Betty, is that it creates regime uncertainty and it will slow down credit growth. We already have broad measures of money that are falling and shrinking, and the reason they're shrinking is that the banks and financial institutions are afraid. They're afraid of the regulations. All these regulations are uncertain.
But some would argue, though, that the agreements put forth after this 20-hour or so marathon session actually clarified some of these positions on regulation.
If you think you understand what it all means, I'd be delighted to hear it.
I don't fathom to understand what it all means, but I would say that some of the bullet points about derivatives, about the Volcker rule, were clarified, no?
Well, you're talking about bullet points. I'm talking about real regulation as it will be implemented, and no one knows how it will be implemented and how it will work its way through the courts and in every other aspect. And this is why you've got so much uncertainty that will remain in the system, and credit and the credit crunch will remain on in the United States as it is in Europe. Broad money measures, including the monetary base and credit, are actually shrinking. And that's the real problem with growth. That's why the stimulus package hasn't worked in the United States.
Professor, we're going to have to leave it there, but great to have you with us. That was Steve Hanke of Johns Hopkins